Welcome back to Retire with Alpha. In video 1, we covered the mechanics of the poor man's covered call, what a leap is, how the two-leg structure works, and why it requires about 74% less capital than a traditional covered call. Today is the decision video. If you want monthly income in retirement, you have 4 real choices, and most retirees only know one of them. By the end of this video, you'll know all 4. You'll know exactly which door is right for your situation, and you'll understand why the Dynamic PMCC is the clear choice for active retirees. Let's get into it. Let's start with a simple mental map, a 2x2 matrix. On the horizontal axis, active versus passive. Active means you manage the position yourself. Passive means a fund does it for you. On the vertical axis, traditional share-based versus options-based using a leap. That gives us 4 doors. Door 1, the traditional covered call, active, share-based. You own the 100 shares and sell the call yourself. Door 2, the standard PMCC, active, options-based. You replace those 100 shares with a leap. Door 3, the dynamic PMCC, also active, also options-based. Same leap foundation as the standard PMCC, but with a regime engine on top. Door 4, JEPI and its siblings SPYI and QQQI. Passive, share-based funds. The fund owns the stocks and sells the calls. You collect the monthly distribution. Notice what's empty in this matrix, the passive options-based corner. There's no fund that does the dynamic PMCC for you. That door only exists if you walk through it yourself. We'll go through the 3 active doors first, then introduce JEPI, then compare all 4 side by side. The traditional covered call is the bedrock. We covered this in video 1, so we'll be brief. You own 100 shares of SPY. You sell a short call against them. The premium you collect is your income. At today's prices, 100 shares of SPY cost approximately $73,500. That's the capital commitment for a single position. If you want to run 3 positions, you're locking up over $220,000. The income is real. The structure is proven. But the capital requirement is heavy. And here's the part that most retirees feel most deeply. The strategy is static. Same strike, same timing, every single month, regardless of what the market is doing. A bull run, you're capped. A drawdown, your shares are bleeding and your monthly premium is doing its best but can't keep up. It works, but we can do better. That's the whole point of the next 2 doors. The standard PMCC solves the capital problem from video 1. Instead of buying 100 shares of SPY for $73,500, you buy 1 deep in the money leap, roughly 80 delta, 360 or more days out, for approximately $19,000. Against that leap, you sell a monthly short call. Out of the money, around 30 delta, 30 days to expiration. You roll it once a month, same as a traditional covered call writer would. Except you've deployed about 74% less capital to get there. Same income exposure, same monthly process. But about $54,000 stays free as a safety net, as dry powder, as peace of mind. So the standard PMCC is better than the traditional covered call in one important dimension, capital efficiency. It does the same job with less money on the table. But, and this is important, it's still static. The short call goes out the same distance every month. The strike doesn't change with the market. Which brings us to door 3. Before we open door 3, let's be honest about where the standard PMCC stops. In a strong rally, your combined position is positive 50 delta, 80 from the leap minus 30 from the short call. So you make money. But your upside is capped at the short strike, and after a big move, you feel like you left a lot on the table. That feeling is real. In a drawdown, the leap loses real money. A monthly 30 delta short call doesn't collect enough premium to absorb a meaningful move lower. And there's no built-in defensive mechanism, nothing that automatically responds to the market getting worse. Here's the way I put it. A standard PMCC is a structure. It tells you what to own and how to set it up. But it doesn't tell you what to do when the market turns on you. It doesn't adapt. That's the gap the Dynamic PMCC fills. The DPMCC is built on the same foundation as the standard PMCC, one deep in the money leap on SPY. But it adds a complete management system on top. 3 principles drive everything. Foundation first. Protect the leap above all else. The leap is the boat. The short call is the fishing net. If you lose the boat, you can't cast the net. Every decision starts there. Regime adaptive. The short call strike and cadence respond to what the market is actually doing. Bullish, neutral, bearish. Each regime has its own playbook. Rules-based. Every entry, every roll, every exit condition is defined in advance. You follow the process. Emotion stays out of it. Let's zoom in on the part that does the most work. This is the single most important slide in the video. In a bullish regime, when the market is trending up, you sell the short call out of the money. You give up a little premium in exchange for letting the leap appreciate. You keep the upside. In a neutral regime, when the market is range-bound, you sell the short call at the money. That's where premium income is maximized. You're the landlord collecting full rent on a tenant who has no intention of moving. In a bearish regime, when the market is trending down, you sell the short call in the money. And this is the part most retirees never learn. An in-the-money short call gives you a dollar for dollar downside buffer on the leap. Every dollar the leap loses, the short call gains. You collect bigger rent and protect the boat at the same time. That's the DPMCC's defensive layer, the thing the standard PMCC doesn't have. Now, the precise indicator that tells you exactly which regime you're in, whether to flip from neutral to bearish, for example, we'll cover in a later video. For now, just understand the logic. The strategy watches the market and responds. A standard PMCC is a structure. A dynamic PMCC is a process built on top of that structure. One that tells you exactly what to do in a rally, in a flat market, and in a drawdown, and exactly when to walk away. Strike selection isn't the only thing the DPMCC tunes. Cadence matters too. A standard PMCC sells a monthly call, 30 days out. That's its rhythm. The DPMCC prefers a weekly cadence, 7 days out. Here's why. Options lose their time value fastest in the final days before expiration. By selling at 7 days, you're harvesting theta at its steepest point on the curve. More income per unit of time. If a weekly routine feels like too much, a 14-day cadence works well too. That's the lazy version of the DPMCC. You trade once every 2 weeks instead of once a week. The income is slightly lower, but the effort is much lower, only half. Both are legitimate. Now let's talk about the door most retirees already know. JEPI, the JP Morgan Equity Premium Income ETF, is an actively managed fund that owns a basket of large cap stocks and sells short calls on the S&P 500 through instruments called equity-linked notes. You don't do anything. You just buy JEPI and collect a monthly distribution. Trailing yield is approximately 8 to 8.5%. The fund manages roughly $40 to $45 billion in assets. And to be honest, for the right retiree, JEPI is a fine product. 0 time commitment, diversified across roughly 100 holdings. Drawdowns are cushioned relative to a pure SPY position. If you have no interest in ever learning options mechanics, JEPI is the right answer for you. No shame in that. But, and this is the part many JEPI buyers don't see until it's too late. There are 4 costs baked into that monthly distribution. First, net asset value erosion. Because the fund pays out aggressively, the share price doesn't recover the way SPY does after a drawdown. Total return, price change plus distributions combined, consistently lags a plain SPY position in any meaningful uptrend. Second, capped upside. JEPI participates in roughly 75 to 80% of rallies. The rest goes to the call sellers. Third, tax treatment. Most JEPI distributions are classified as ordinary income outside of a Roth IRA. At retiree marginal rates, that adds up. In contrast, DPMCC premium collected inside a Roth IRA is tax-free for life. Every dollar, every year, compounding with no tax drag. And fourth, and most important, yield is not return. An 8% distribution can coexist with a negative 2% total return in a bad year. If the share price drops 7% and you received 8% in distributions, you're not up 8, you're up 1. Retirees who focus on the yield number and ignore the total return math don't always see this until it's too late. Let's look at all 4 strategies on one slide. Capital required. The traditional CC needs about $73,500 for a single SPY position. Both the standard PMCC and the DPMCC need about $19,000. Same leap, same foundation. JEPI is flexible. You can buy as little or as much as you want. Management. The traditional CC and standard PMCC are both monthly. The DPMCC is weekly or 14-day. JEPI is none, zero effort. Strike behavior. The traditional CC and standard PMCC are both static, same strike every month. JEPI is set by the fund. The DPMCC alone is regime adaptive. The strike changes with the market. Defensive layer. The traditional CC has none. The standard PMCC has none. JEPI has a modest one at the fund level. The DPMCC is the only strategy with an explicit built-in defensive layer, the ITM buffer in bearish markets. Taxes. In a Roth IRA, the first 3 are all tax-free. Outside a Roth, JEPI is the least efficient. Most of its distributions hit as ordinary income. DPMCC premium in a taxable account is mixed, but inside a Roth, it's the most efficient of the 4. The DPMCC and the standard PMCC cost the same capital. The difference. Let's be honest about who each door is for. If your account is under $20,000, or if you have zero interest in ever learning options mechanics, JEPI is the right answer. There's no shame in that. But if you're an active retiree with at least $20,000 to deploy, and you're willing to commit 30 to 60 minutes a week, the Dynamic PMCC is the clear choice. More income per dollar of capital, a defensive layer the others don't have, and in a Roth IRA, every dollar of premium is tax-free for life. In video 3, I'll walk you through exactly what a $50,000 DPMCC account looks like in practice. Real strikes, real numbers, real monthly income targets. If you found this useful, hit subscribe and ring the notification bell. See you in video 3. Everything in this video is for educational purposes only. It is not financial advice. Options trading involves risk. Past performance does not guarantee future results. Please consult a licensed financial advisor before making any investment decisions.